Same person, same job. 3 years apart, one number changed in his bank account. $50,000. Watch what happens next. Here's what nobody tells you. At $49,000, you're still figuring it out. At $50,000, 5 doors you couldn't see yesterday are suddenly open. Most people walk right past them because nobody ever pointed them out. I'm about to show you exactly where they are. 2 people, same salary, same $50,000 saved. Person A knows what we're covering in the next 20 minutes. Person B doesn't. 10 years later, Person A is financially free. Person B is still stressed about money. The only difference is what happens in this video. I'm Kevin. This is Prosperity Levels. We skip the motivation speeches and show you the actual mechanics. Today, 5 doors, real numbers, specific actions you can take this week. Let's go. Door 3 sounds boring. When I first heard it, I thought, there's no way that's the secret. Then I looked at the financial statements of regular people who retired comfortably. Same thing, over and over and over. When we get there, don't skip it because it doesn't sound exciting. That's exactly why it works. Why this number? Because at $50,000 invested, your money starts generating $3,500 a year while you sleep. That's a car payment every month, forever. You worked for the first $50,000. Now, it works for you. Princeton researchers found something wild. Financial stress eats up the equivalent of 13 IQ points. Not because you're less smart when you're broke. Because your brain is running a background program constantly calculating bills, rent, what-ifs that consumes processing power. When you have 50,000 properly deployed, that program shuts off. Suddenly, you see opportunities you were blind to before. You negotiate differently. You take smarter risks. You think 10 years ahead instead of 10 days. It's not motivation, it's neuroscience. Researchers call it survival mode versus strategy mode. Below 50,000, protect what you have. Avoid risk. Accept mediocre. Above it, seek growth. Think long term. Say no to bad deals. 50,000 is where most people flip that switch, if they know how. Door 1. Real estate income. No landlord nightmares. No tenant calls at AM. No 20% down payments. Just real estate exposure that pays you while you sleep. Median home price in most cities? $400,000. Down payment? $80,000 minimum. Then you're a landlord. That's a second job. There's a better way nobody talks about. At 50,000, 3 vehicles open up. REITs, publicly traded real estate companies. Crowdfunding platforms, fractional ownership in actual properties. Syndications, pooled investments in apartment complexes and commercial buildings. Let me show you which one fits you. REITs own massive real estate portfolios. Apartment buildings, data centers, warehouses. By law, they have to pay out 90% of profits as dividends. Average yield, 4 to 6%. 25,000 in REITs at 5% equals $1,250 a year deposited in your account. 0 toilets to fix. Not all REITs are equal. Industrial REITs, warehouses powering e-commerce. Growing. Data center REITs, infrastructure for AI and cloud computing. Exploding. Residential REITs, apartments. Strong demand because people can't afford to buy. Office REITs struggling. Remote work isn't going away. Pick the sectors where the trend is your friend. Starting out, buy a REIT index fund. One purchase. Hundreds of properties. Every sector. Instant diversification. Vanguard's VINC or Schwab's SH. Simple beats overwhelmed every time. Platforms like Fundrise and Realtamago let you own pieces of specific properties. An apartment building in Austin. A warehouse in Phoenix. At 50,000, you can diversify across 5 to 10 different properties. Institutional strategy. Laptop execution. Private real estate deals. Big apartment complexes. Commercial buildings. Returns run 8 to 15%. The catch? Many require accredited investor status. Income over 200,000 or net worth over $1 million. Not there yet? REITs and crowdfunding work today. And 50,000 puts you on the path. You don't need to buy a building to own real estate. You just need to know these 3 vehicles exist. That's door 1. Door 2. The private markets. This is where the wealth gap actually gets created. There are two investing systems in America. The public market, what your 401,000 is in. The private market, where people invest in companies before they go public. Public market 7% average returns over a century. Private market 10 to 20 times that for successful investors. Why? You're getting in before the growth story goes public. Before regular investors even know the company exists. For decades, regular people were banned from private deals. The barrier, accredited investor status, income over 200,000, or net worth over $1 million. The gate was locked. Then the Jobs Act of 2012 happened. It didn't tear down the wall, but it cracked the door open. Regulation. Crowdfunding Reg CF allows private companies to raise from non-accredited investors. Platforms like Republic, Wefender, Starting. For the first time ever, you can invest in early-stage companies before they're publicly traded. Think about the companies that created generational wealth. Amazon's early rounds. Google in '98. Facebook in '04. Uber in 2010. All the life-changing returns happened before these went public. That room is now partially open to you. Let me be straight. 9 out of 10 startups fail. This is money you must be ready to lose entirely. So how do professional investors make money if most fail? They don't pick one winner. They make 20 small bets. Most fail. A few return capital. 1 or 2 return 50 times. That one winner covers everything and generates the profit. At 50,000, here's the play. 5 to 10% into private markets. 2,500 to 5,000 total, spread across 5 to 10 companies. Each position small enough that if it zeroes out, you're fine. Diversified enough that you might catch a winner. Before you invest, 5 questions. Real customers? Real revenue? Founder done this before? Market big enough? Hard to copy? If all 5 aren't clearly yes, pass. 50,000 today, deployed right, puts you on a 10-year path to accredited status. At that point, the best private deals open fully. You're building toward it and participating at a starter level now. Door 3. Before I tell you what it is, picture someone you know who's genuinely financially stable. Not Instagram rich, actually stable. When their car breaks, they fix it. When they take vacation, it's not on a credit card. They never talk about money. They're just fine. Got someone in mind? That person made one decision. Usually in their 30s or 40s, they put a chunk of savings into fixed income, treasury securities, bonds, high-yield CDs. I know. You're thinking, that's it? That's the secret? Bonds? Yeah, I know. Give me 60 seconds. YouTube has a content problem. Boring and effective doesn't get views. Exciting and destructive does. So you get endless crypto videos, options trading, real estate flipping, almost zero about the instruments that actually quietly build financial security. 2022, stock market down 20%. bonds, government savings bonds that adjust with inflation, paid 9.62%. Guaranteed. Zero risk. Backed by the US government. While everyone else was watching their portfolios bleed, bond holders collected interest. Your emergency fund is in a savings account earning 1.5%. Inflation is running at 3%. You're losing 1.5% of purchasing power every year without making a single bad decision. bonds solve this automatically. They adjust with inflation. TreasuryDirect.gov. Government site. Create account. Link bank. Buy bonds. Max. 10,000 per person per year. Time required. 18 minutes. Rule 1. Locked for 12 months. This isn't your immediate emergency fund. It's your backup reserve. Rule 2. Redeem before 5 years. You lose 3 months of interest. After 5 years, penalty free. That's the price of inflation protection. Worth it. More powerful move. A treasury bill ladder. Take 20,000. Split into 4 chunks of 5,000. One T-bill matures every 3 months. When it matures, roll it into a new 12-month T-bill. A perpetual income stream. Quarterly payments. Government-backed. Currently earning 4 to 5%. On 20,000, that's 800 to 1,000 per year. Automatic, invisible, running in the background forever. Wealthy people don't use fixed income instead of growth investing. They use it as the foundation that makes aggressive growth possible. When your emergency fund is earning 4% automatically, you can put your growth capital into higher risk opportunities without the fear that forces bad timing. Security enables aggression. 20,000 in I-bonds and T-bills. 900 a year risk-free. 30,000 in REITs, index funds, private markets. 2 tracks running simultaneously. Safe money working. Growth money hunting. That's door 3. Door 4. Business ownership. Not, quit your job and start a company. I mean buy a machine that's already running and collect what it produces. Starting from zero is brutal. Build systems. Find customers. Generate trust. All while spending money and making nothing. 90% fail within 10 years. Don't play that game with your first 50,000. What if you bought a business instead of starting one? Existing customers, existing revenue, existing systems, a cash machine you step into, not build from scratch. There's a massive market for this nobody talks about. 12 million baby boomers are retiring over the next decade. Many built real businesses over 20, 30 years. Many have no succession plan, no kids who want it. They want out, and they're pricing reasonably. On acquire.com, Flippa, Bizbasell online businesses generating 2 to 5,000 a month in profit sell for 40 to 80,000. Content sites, e-commerce stores, SaaS tools, verified revenue, existing customers. 50,000 is a serious position. Here's where it gets interesting. Small business administration loans are designed for acquisition. 50,000 down can finance a $500,000 purchase. Your money becomes a lever. Service business generating 4,000 a month profit. Price, 250,000. You put 50,000 down. Spa loan covers the rest at 6.5% over 10 years. Monthly loan payment, 2,000. Net cash flow to you, 2,000 a month. 24,000 a year on a $50,000 investment. 48% return. This isn't passive. This requires work. You have to verify every number through direct platform access, not screenshots. Understand why they're selling. Burnout is fine. Declining revenue is a red flag. Get a lawyer. Get an accountant. Treat it like a professional process. If you want pure passive income, stick with REITs. But if you have 10 to 15 hours a week and want to own a real asset, this is one of the highest returning plays available. Almost never discussed because it's complicated. Door 5. Negotiating power. This doesn't require investing a dollar. It activates automatically when the other 49,000 is deployed, and it multiplies every other financial outcome you'll have. There's a tax on having no savings. It shows up in every job offer you accepted without negotiating, every lease you signed at asking price, every bad client you tolerated. That tax costs most people hundreds of thousands over a lifetime. 50,000 gives you one thing that changes everything. The ability to walk away. I don't need this badly enough to accept a bad version of it. That sentence, backed by real savings, changes what you earn, what you pay, what you tolerate. Job offer at 80,000. No savings, accept immediately. 50,000 in the bank. I'm excited about this role. Based on my research, I was expecting 90 to 95,000. Is there flexibility? Then silence. Most people panic and soften. You can afford to wait. Employers feel that. Studies show financially secure candidates negotiate higher salaries consistently. Over a 20-year career, that difference is a house. Buyer with 50,000 in savings gets treated differently. Better rates, stronger offers, strategic contingency waivers. The difference on a single transaction can be tens of thousands. Self-employed, clients sense desperation. 50,000 in the bank changes your energy. Higher rates, better terms. Walking away from low-value clients. Walking away from the wrong clients is the most powerful financial move a freelancer can make. You can only do it when it doesn't terrify you. Remember 13 IQ points consumed by financial stress. Less creativity, less strategic thinking, less ability to see long term. 50,000 shuts off that background fear program. The mental clarity shows up in better decisions for years. Doors 1 through 4 generate returns you can measure. Door 5 generates a return that multiplies everything else. Higher salary invested over decades. 1 avoided bad deal, saving years of recovery. Better negotiations, saving thousands repeatedly. It's not a one-time event. It's a permanent upgrade. Here's exactly how to deploy 50,000. 3 buckets. Security 15,000. I-bonds, T-bills, or high-yield savings earning 4 to 5%. Your emergency reserve now working instead of sitting. This is the foundation that lets you take intelligent risks everywhere else. Growth 25,000. Index funds for core equity. REIT ETF for real estate income. 2 to 3,000 across private market platforms. Your wealth building engine. Opportunity 10,000. Reserved, not deployed yet. Business acquisition research fund. Learning capital. Patient money waiting for the right use. Door 5 activates. Doesn't need allocation. Turns on automatically when the other money is deployed. You don't buy negotiating power, you become it. Door 3 first. TreasuryDirect.gov. 18 minutes. Today. Door 1. Next. 1. REIT ETF purchase. Door 2 when ready for calculated risk. Door 4 when you have bandwidth. Door 5 runs from day 1. You don't do everything at once. You start with one step. Today. 80% of people with 50,000 in savings aren't using any of these doors. Money sitting at 1 to 2% while inflation takes 3 to 4. Working backwards every day without knowing it. Saving isn't the finish line. Deploying correctly is the second half. Open TreasuryDirect.gov today. Move emergency fund from 1.5% to 4 to 5. 18 minutes. Makes every other door feel real instead of theoretical. Conservative path. 30,000 in security, 20,000 in REIT ETF. 1 year later, dividends reinvesting, bond interest compounding, emergency fund protected. Not exciting, completely effective. What most people who quietly retire comfortably actually did. Balanced path. 15,000 security, 25,000 index funds and REITs. 5,000 private markets across platforms. 5,000 reserved for business opportunity. Moderate risk. Reasonable expectations. Active path. 15,000 security. 10,000 index funds. 25,000. Down on online business generating 2,000 a month. Verified profit. 6 months optimizing it. Year later, business generates 24,000 annually. That income fuels growth bucket. Highest risk, most work, highest return potential. 3 paths, 3 outcomes. All 3 end in a fundamentally different position. Not from luck, from understanding what 50,000 unlocks. Most common mistake. Hit 50,000. Celebrate with upgrades. Better apartment, nicer car, more expensive habits. 18 months later, it's gone, and nothing changed. Research everything. Build the perfect spreadsheet. Take no action. Money sits for a year. Then 3. Doors were open the whole time. All in on one idea. One property. One startup. One business. When it doesn't work, and most single bets don't, entire foundation disappears. Diversification isn't about maximizing returns. It's about not losing your first real financial base. REIT dividends taxed as ordinary income in taxable accounts. In a Roth IRA, they compound tax-free forever. Over 30 years, that difference isn't small. After-tax returns are the only returns that matter. I'll invest when the market stabilizes. After the election. When rates normalize. Perfect conditions are a myth. Adequate conditions with a sound framework are always available. Door 1 real estate without landlord duties. Door 2 private markets before companies go public. Door 3 fixed income that protects and enables. Door 4 business acquisition using leverage. Door 5 negotiating power multiplying everything. Pick one door this week. Research it for 2 hours. Take one concrete step. You don't need perfection. You need momentum. If you're not at 50,000 yet now, you know what's waiting. Every dollar you save is cutting a key designed for 5 specific locks. Let that make consistency feel less abstract. Comments. Tell me which door you're walking through first. If you're already using one which generated the best outcome, I read every real comment. At 50,000 or beyond, a fee-only fiduciary advisor is worth it. Personalized guidance on tax strategy and allocation for your specific situation. This video gives the framework. An advisor personalizes it. Before any of these 5 doors, max your tax-advantaged accounts. Roth IRA, SHA if eligible, 401,000 match. Those come first. 5 doors are built on top, not instead. Deploying 50,000 all at once feels overwhelming. 5,000 a month over 10 months. Reduces timing, risk, builds habit. Learn as you go. Correct deployment beats fast deployment. Second, 50,000 is almost always faster than the first. Your invested capital generates returns. You've proven you can do this. The 5 doors contribute income. Velocity increases. 100,000 has its own doors. Larger, more powerful. That's next week's video. The gap between 50 and 100 is where momentum becomes undeniable. Once you hit $100,000, these 7 doors open. Most people miss 4. Subscribe. Notifications on. What unlocks at 100,000 is on a completely different level. People flashing wealth on social media aren't building it. People building wealth look like your neighbors. 10-year-old cars, normal houses, and 50,000 in I-bonds, 25 in REITs, and a business generating 2,000 a month. Nobody knows about. Wealth is quieter than you think. Wealthiest investors share one trait. Not intelligence, not information, time horizon. Buffett didn't pick better stocks. He held good companies longer than anyone else would. At 50,000, the most powerful decision beyond deploying correctly is deciding not to touch it for a very long time. You're not executing a strategy. You're becoming the type of person who deploys capital intelligently. That identity shift from someone who saves to someone who builds is the real transformation. The money is just evidence. The doors are open. They've been open since you crossed 50,000. Only question is whether you walk through them. Most won't. You're not most people. I'm Kevin. This is Prosperity Levels. We break down how wealth actually builds, one milestone at a time. Go walk through those doors.